Welcome to Business Matters. Today's lesson will be looking at taxation. Taxation, a means of revenue for the government. Our objectives for this lesson, they are 1. To state what is tax, explain the principles of taxation, state the purposes of taxation, distinguish between progressive, regressive, and proportional taxation, and we'll be seeking to distinguish between direct and indirect taxation. Let us begin. Taxation. What is taxation? What is tax? Well, tax is primarily, one thing we want to lay down here is that taxation is a primary way in which government receives funds to finance budgeted expenses for the country. So the government has a lot of things to do for the general welfare of the citizens. And to finance these activities, the government collects taxes from the citizens and businesses to be able to provide these services. So what is tax? Well, tax is a compulsory payment, a compulsory monetary payment levied on income, profits, goods and services made by individuals and corporations, and it is given to the government. Now, let's look at the principles of taxation. In the 18th century, an economist gave rise to the idea of the principles of taxation. His name was Adam Smith, and he posited 4 principles of taxation. Adam Smith was seeking to indicate that government, when they are collecting from the people monies, they must treat with it in a certain way. Let's look at the ways that it should be. 1, the tax system of government should be equitable. And by that he meant the burden of tax should be more or less the same for each taxpayer. So each taxpayer must be paying tax based on their level of income. Now, each citizen ought to contribute towards the support of the government because they will be benefiting from all the services that are provided by the government. The second principle that was posited is that tax should be economical. Tax should be economical, and by that we mean taxes should not be expensive to collect and administer. Otherwise, the purpose would be defeated. So, if the government is to collect, let us say for argument's sake, $10 million of tax, but in putting in the processes to collect the tax, they are spending $15 million, then that is not economical. They are spending more to collect the tax than they would be receiving as tax. So the government must make sure that the processes that are in place in collecting the tax, yes, it is economical, right? The processes of going through to collect the tax must be cheaper than the actual tax being collected. Third principle is that there must be certainty with the tax. Government must make sure that the tax which each individual is bound to pay ought to be certain and not arbitrary. The time of payment and the manner of payment and the quantity of payment ought to be clear, plain to the taxpayer, and to every other person. In other words, the government should make sure that the citizens, yes, understands the tax system, understand the reason for collecting, understand at what time. So it must not be a situation where they are forgetting when they should collect the tax. The time when the tax must be paid, yes, and the manner in which it is paid, it must be clear to the citizens, so it makes it easy for them to pay over their taxes. And the fourth principle is that the tax must be convenient. Now, what Adam Smith proposed here was that every tax ought to be levied at the time or in the manner in which it is most likely to be convenient for the contributor to make it. So, ladies and gentlemen, when we say that the tax should be convenient, it means it must be easy, right? The system that is in place must be easy for the taxpayer to make their contribution to the tax. It must not be laborious. It must not be difficult. It must not be hard to understand, but it must be convenient. The government must allow there to be outlets that are at a location that is convenient to the taxpayer to make their portion of the contribution. So now we are going to move looking at the purpose of taxation. Why is it that government seeks to tax its citizens? Now, the main purpose of taxation is to finance government public expenditure. Yes, and by public expenditure we mean spending for those things that will benefit the general citizenry. Building roads, building hospitals, building schools. Yes, these are facilities that will benefit the general citizenry. Now, without the revenue from taxes, yes, government would be unable to pay for key public services such as health, education, defense, policing, and roads. If there were no monies coming in, then these persons would not be able to be paid, so that the doctors and nurses in the health department, the teachers and all educational workers, the soldiers and all those who work in the defense force, the police force, and of course there will be no proper roads to commute from one location to another. So, purpose of taxation. One is to curb inflation. What is inflation? Inflation is really where the prices of the goods and services have been increasing rapidly. Yes? And so the price is going up, but the goods are remaining the same. So your purchasing power is reduced. So inflation is really when the price of goods and services continue to rise at a rate that becomes expensive to access the goods and services, right? So inflation, so one of the purpose of taxation is to curb inflation. So what that means is that the government don't want the prices to get so high that the general citizen will not be able to access the necessary goods and services for them to live a comfortable life. So the government uses the process of curbing inflation to reduce money supply in the economy, and they do what is called mapping up of liquidity, right? The government seeks to map up liquidity, and by mapping up here is to pull back some of the monies that is floating and circulated in the economy, so that there will be the price of things will go down. Right? When there's too much money in the economy, you're going to have too much money chasing few goods, and that is going to create inflation. The price is going to go up. Once there's a demand for the product, then the price will go up. So if there's a reduction in the amount of monies available, yes, then it will now reduce. The producers will now be forced to, the demand will be reduced for the goods, and when demand is reduced, then the price will go down, and then the citizens will access, right? So to curb inflation, the government is seeking to mop up liquidity, to use some instrument and means, use taxation as a means of taking back some of the monies that are in circulation in the economy to reduce the inflation. The second purpose of taxation is to remove the competition. To move competition, right? That is protecting, in essence, to protect local fledgling in businesses by increasing taxes on imported substitute. What that means is that what the government does, all right, so when the local businesses, young local industries are upcoming in the country, the government must protect the citizens and protect the business, because that is the life of the government. In other words, there'll be more employment. When there are more small business coming up and they are growing, then it means more of the population will be gainfully employed. Less person will be moving into crimes and antisocial behavior. So it has a ripple effect. So if government seek to move to the competition, remove competition, yes, for particular industries, particularly young industries that are coming up, what that does for the country is that it gives the local business more opportunity to grow. It gives the local industries opportunity to grow. So taxes reduce the competition, meaning when the government tax imports, the price of goods will go up. The price of goods will go up, and when the price of goods goes up, when the price of goods goes up for imported products, then the consumer will not purchase those goods as they would do the local goods. So the local goods will be cheaper than the imported goods. There was a time in Jamaica when chicken parts were being dumped in the country. And as a result of that, there was too much chicken in the country, and the price of chicken went down. Right? The price of chicken went so low that the chicken farmers in the country, yes, had difficulty in continuing their local production, because the imported chicken, the price for the imported chicken was so low that they could not compete and survive. So what did the government have to do? The government had to institute tax on the imported goods like the chicken and so on, so that the price of the chicken will go up. And when the price of the imported product goes up, then the local products will be having a competitive advantage and ability to survive. Now, the third reason for the taxation is that it reduces consumption of undesirable commodities like alcohol and cigarettes. So government wants to reduce the consumption of these unhealthy product and addictive products, so they put a lot of tax on it so that it will reduce the amount of persons who will be likely to want to use it. Now, the government also use taxation to lower unemployment. I wonder how that is done. How is it that the government use taxation to lower unemployment? Well, they encourage, when government use taxation a certain way, to encourage citizens to buy local produce goods, right? Local produce goods they will increase in demand, and when more goods, local produce goods, are in greater demand, then you're going to have more persons being demanding for employment. So as we have said before, when government put tax on importing products, right, then the local produce goods will be cheaper. So as a result of that, it will be cheaper and will be in higher demand. When the goods are in higher demand, then the businesses now will require more laborers to do the production, and so increasing employment and reducing unemployment. Other purpose is to gain total control of the economy. Now government use tax to give allowance for certain investment. So if the government, for example, there's a time when sugar production we had a significant competition from Brazil and from other countries. Yes, they were producing a lot of sugar, and the Caribbean countries were unable to compete. So what did the government do? Government started to give some tax breaks to agricultural producers, so that they may launch out into new production areas to develop the agriculture area. So they use the tax to and give allowances. So the government allows, for example, government allows people like farmers to import tractors and equipment and materials for their agriculture without any tax. They give them a tax allowance so that it is easier for them to obtain these items, yes, and be able to carry on their production. The sixth way that government, why government tax, is that they seek to improve a balance of payment position. Now, what do we mean by balance of payment position? A balance of payment, whenever government import goods, they will have to pay for it using the currency that they have, the currency of the country to which they are doing business. So if the Caribbean countries are importing goods from the United States, then they will be required to pay for those goods not in Trinidadian dollars, not in Barbadian dollars, not in Jamaican dollars, but in US dollars. So when the government use the tax, yes, tax the imported products, they'll get more foreign exchange to be able to pay off the goods that are imported into the country. Now, also, government seeks to achieve greater equality. So government carry out taxation to use it as a means of attaining greater equality in the economy. Now, in many democratic or capitalist economy, you have an uneven distribution of wealth among the citizens. Maybe you have a situation where a small proportion of the citizenry are very rich, and a great majority and masses of the population, they are poor, right? So the government is like the midway house to bridge the gap between the high demand, the rich and the poor. So government tax, yes, use the taxation to pull from the rich and the wealthy and high income taxpayer, yes, to distribute to the poor, right, to provide social services to the poor. Now we're going to look at the forms of taxation. Now, let's distinguish between we want to distinguish between the progressive tax, regressive tax, and proportional taxation. Now, proportional taxation is where we have each taxpayer pays the same amount, or same proportion rather, of his income in taxes. So it's the same proportion. So if there's an employee who is earning $1,000, the employee is going to be paying 10% of that $1,000, yes, which would then be 10% of $1,000 will be $100, right? if the employee is earning $100,000, then 10% of the 100,000 is $10,000. So each employee or each individual is paying an equitable amount in terms of the proportion, based on the proportion of their earnings. So proportional taxation is where each taxpayer is paying the same proportion of their income in tax. Then you have regressive taxation. Now, regressive taxation is progressive, beg your pardon. Progressive taxation, higher income earners pay a greater percentage of their income in tax. As your income rises, what happens is that you are required to pay more. So, for example, in some countries in the Caribbean, they have 2 or 3 income tax rate. So there's a general income tax rate of 25% for the general citizens who are earning up to a certain threshold or amount. But persons who are earning, let us say, above $3 million will be paying, for example, 33.5%, while those who are earning less than that will be paying 25%. So what you find is that the people who are higher income earners are paying more in taxes than the general population, and that is what is referred to as progressive. Now, how is that progressive? This is what I want to pause to share here. Why is it referred to as progressive if you are allowing the higher income earners to pay more? How that becomes progressive? The point is, when you are requiring of higher income earners to pay more and lower income earners to pay less tax, then the lower income earners will have more disposable income to save. And as that lower income earner has the capacity to save and more disposal income, that individual can grow, maybe start a business because they're having excess. They can have excess income to save and start a business and start earning more. And when they are earning more, they are now going to be taxed more. So it is referred to as progressive tax because the lower income earner is given paying less tax, and thus who have the ability to have more savings, more disposable income at their disposal to use it maybe to invest into other businesses or to invest in ways that will lift their level of standard of living and lift their income level. And when their income level, more and more people now will go up to the higher income bracket because they would have the capacity and the latitude to do so as the time goes by. So that is why it is called a progressive tax. Progressive, not that because they are taking more money from the higher income, but because the lower income earners are given more space for them to rise to the capacity of becoming a higher income earner. The third form of taxation is referred to as regressive taxation, and the lower income earner this time around is paying more tax. Consumption tax, particularly consumption tax, are considered to be regressive tax. And the question is, why is it consumption tax or regressive tax? Because the general lower income earners, they spend more in buying the goods, and every time they are purchasing the goods, they are paying tax. And therefore, if the little income earner goes to the supermarket and is buying a few little goods, they are paying tax. And because they are continuing to do that over and over, paying the little by little, they're paying, the accumulated amount is going to be greater than the higher earning income, the higher earning individual. Why? Other point I want to make is that the richer or the higher income earner will pay less under a regressive tax because they are able to buy goods in larger amounts. And when they are able to buy in larger amounts, they may access discounts and allowances. And these discounts and allowances will average out the income tax. So for example, a person is higher income earner is buying 10 tons of material, right? And by buying 10 tons of material, he's getting 10% discount. By getting the 10% discount and the tax now that is going to be in it, he'll be mad. And let us say the tax is 15%. He is not actually paying the 15% of the tax. He's really paying 5%. Because he's getting a reduction of 10% by way of the discount that is provided. And again, higher income earners do not purchase things as frequent as lower income earners. They make one big payment and whatever they purchase is going to last them for a while the lower income earners are purchasing things, yes, in small portions, so they are paying more. Let's continue now. We're going to look at the types of taxation. Types of taxes. All right, so we have two main types. The first one is referred to as direct tax. Direct tax. The tax burden of the taxpayer falls directly on the individual and corporation. That's why it's called direct tax. The burden of paying over the tax is the responsibility of the individual and the corporation. It is applied to income, capital, and wealth. So direct tax is applied to income, capital, and wealth. And of course, profits, if you want to go a little bit deeper. Normally charged, so direct tax is normally charged as a percentage of the income and the wealth that you have. And this tax is taxed at source. So like for example, a worker, yes, is taxed by the government, their income tax. Before their monies come to them, the government is withdrawing the tax from their salaries. So it's a tax at source. They are taking the tax before the money reaches you. Now, example of direct tax is income tax. Yes, and this is charged on individuals' income. Of course, you would have heard me indicating, and in most countries, it is 25%, between 25 and 33% for income tax. Another type of direct tax is corporation tax. Now, this is a tax paid on profits earned by the company, right? So when the company works out its financial statement, its income statement, and they have calculated, and when they're finished their income statement, it is showing that they're making a profit. There's a net income or a net profit. They're charged a tax based on the amount of net income or net profit that they have earned for that period. Another example of direct tax is capital transfer tax. This is levied when property is transferred from one person to another. So if your father, all right, is giving you the house or the land or the car, yes, government says you did not work for it, so you're coming into this wealth and you must pay a price for it. So the transfer of capital, the transfer of your wealth, yes, so you pay a tax for the transfer of the wealth that is coming to you. And then we have what is called capital gain tax. Now, capital gain tax, whenever, for example, let me first say, it's a tax levied on the increased asset value, yeah, the increased value of the asset. So, what happens here is whenever you sell an asset or dispose of an asset, the profit you make from the disposal of the asset, you are required to pay a tax on it because you are gaining on the transfer or the sale of that asset. So referred to as capital gain tax. Now let's move to indirect tax. The burden and the payment falls on different individuals. Let me say that again. With indirect tax, the burden and the payment falls on different individuals. It is levied on goods and services, primarily levied on goods and services. Usually paid by manufacturers or importer who passes the cost on to the consumer in the form, yes, of the price for the product. So the indirect tax, for example, the manufacturer is expected to pay tax on their goods that they are producing, right? And in order to pay that over to the government, yes, they include that tax in the price and the production cost of their business and pass it on to the consumer, and the consumer then pays the tax, right? Now, examples of indirect tax. We have custom duties, and this is a tax that is charged on goods imported. So when businesses or individuals are importing appliances, motor vehicles, etc., the government charges you a tax called a custom duty for imported. So remember, once we're charging a tax on imported goods, it is called custom duties. Then we talk about excise duties. Now this has to do with export, right? While custom duties deal with imported goods, excise duties deal with exported goods. So tax on goods produced in the country, and so the goods, yes, will be charged a tax, those goods that are going to be exported. For example, alcohol, we produce the alcohol and then you're going to export it, and excise duty is charged. The popular indirect tax is really referred to as purchase tax, right? A tax that is charged mainly on manufactured goods and services brought into the country, beg your pardon. So when manufacturers by our other businesses import goods into the country, they're going to transfer that purchase tax, yes, to the consumer, as we said before. Now, general consumption tax is a type of purchase tax. A tax on general consumption tax is a tax levied on consumption, spending on goods and services. So whenever you go to the supermarket, to the store, and to those places to access the goods and services, a tax is included in the product that you are buying. Then you have what is called ad valorem tax, or value added tax, the VAT.